You know, for most of us, our superannuation feels like this locked box of money we won't see for decades. But what if you could turn it into a powerful engine for building wealth right now? Well, today we're going to dive into a pretty big and sometimes controversial strategy, using your super to buy property. And it all kicks off by challenging a piece of advice you've probably heard 1,000 times.
And there it is. Our source material calls this one of the biggest lies in finance. The conventional wisdom? The thing you hear from almost everyone is that you need at least 200 grand in your super before you should even think about managing it yourself. Why? Because they say the fees on anything less would just chew up all your profits. But we're about to see how that whole argument kind of falls apart when you introduce one of the most powerful tools in finance, leverage.
So how do you actually do any of this? Well, the key that unlocks the whole strategy is something called a self-managed super fund, or an SMSF. Think of it this way. Instead of some massive, faceless fund managing your money, an SMSF lets you get in the driver's seat. You become the trustee, which gives you direct control over where your retirement savings go.
And once you're in control, a whole new world of investment options opens up. I mean, you can still buy your normal shares and ETFs, of course, but you can also venture into things like cryptocurrency. And for the strategy we're talking about today, the big one is real estate. An SMSF is the only way you can use your super to buy direct property.
Okay, this is where it gets really interesting. This is the heart of the whole idea. We're going to compare two different paths you could take with your super. Path A is the traditional route, right? Just investing in something like a portfolio of ETFs. But Path B, that's where we use that same money to leverage into a much, much bigger property asset. Let's see how the numbers actually stack up.
So, let's use a scenario straight from our source material. Imagine you've got $150,000 sitting in your super. With Path A, you take that whole amount and put it straight into ETFs. Simple enough. But with Path B, you use that same $150K not to buy an asset, but as a deposit and to cover your costs, which lets you get a loan and buy a $600,000 investment property.
All right, let's look at the return on Path A. Now, according to the source, let's imagine a fantastic year, a best-case scenario. You get a massive 15% return on your ETFs. On your $150,000, that's a gain of $22,500. Hey, that's a pretty great result. But let's check out the alternative.
Now, have a look at Path B. To make this a fair comparison, the source uses a very conservative, almost worst-case growth rate of just 5% on the property. But here's the absolute game changer. That 5% growth isn't on your deposit. It's on the entire $600,000 asset. That is the raw power of leverage. That tiny 5% growth just made you $30,000.
I mean, this chart just spells it out, doesn't it? Even a pretty bad year for property outperforms a fantastic year for ETFs. It's because your capital is working so much harder for you. It's controlling a much bigger asset. And just think, what if that property had a more average year, say 10% growth? Well, that would be a $60,000 gain, completely blowing the other option out of the water.
Okay, I know what you're thinking. That sounds amazing. But this is the moment where we have to slam on the brakes, hard. Because this strategy comes with a very specific and very strict set of rules. You absolutely cannot treat an SMSF property investment the same way you would a normal one. This table shows two massive differences. First, you're going to need a bigger deposit. The banks are way more cautious with SMSF loans, so they'll usually only lend you up to 80% of the property's value. And second, and wow, this is a big one, you cannot access the equity.
So what does locked equity even mean? Well, with a personal investment property, if it grows in value, you can often go back to the bank, refinance, and pull that new equity out to use as a deposit on your next property. It's how people build portfolios. Inside an SMSF, you can't do that. It's against the rules. All that capital growth is trapped inside that one single asset until the day you sell it.
The stakes here are just incredibly high. And this quote from our source really drives it home. Think about it. Your super is your retirement insurance policy. If you buy a dud property in your own name, it's a painful mistake, for sure. But if you buy a dead property inside your super, you could be wrecking your entire retirement plan. There is literally no room for error. So let's circle all the way back to that initial lie about needing 200 grand. If this strategy can be so powerful, why do so many accountants give that advice? Well, their logic is usually based on the kind of returns you'd get from unleveraged assets, like stocks and shares. So the conventional thinking goes something like this. Okay, on your $150K balance, a good 10% return in shares gets you $15,000. But then you have to subtract, say, $5,000 in annual fees to run the SMSF. Your net gain is just not that exciting. And you know what? That logic is totally sound if you're only thinking about unleveraged returns. But as our source points out, the entire equation gets flipped on its head when you bring property leverage into the picture. If that same super fund is making you $30,000 a year in growth, or even more, well then paying $5,000 in fees to make that happen suddenly seems like an amazing deal, right? The potential return can just dwarf the cost.
So what is the real minimum then?
Well, the source suggests it's actually closer to $120,000. Why that number? Because that's about what you'd need to cover a 20% deposit plus all the costs, like stamp duty, on a decent, high-growth, entry-level property around that $500,000 mark.
Now, the most crucial takeaway from all of this is that this is absolutely not a do-it-yourself strategy. Our source could not be more clear on this. You need a top-notch team, a really good accountant who specializes in this stuff, and a specialist mortgage broker who knows the ins and outs of SMSF loans. And, above all, since you only get one shot, the property you buy has to be an A-grade, high-growth asset. No messing around.
And that really leaves us with the final, critical question you have to ask yourself. On one hand, this strategy could potentially turbocharge your retirement savings by letting your money control a much larger asset. But on the other hand, it means taking on a huge amount of debt inside your retirement nest egg, the one place where you have zero margin for error. So you have to weigh that immense potential against some very real risk. Is it a risk worth taking?